Good morning, everyone. Thank you so much for joining us on this financial planning workshop, which is in collaboration with APS Wealth. So I'd like to welcome everyone from G4G, the mentees, the mentors, as well as the alumni, as well as welcome Megan Kruger and Kelvin Kruger from APS Wealth. So just to introduce who APS Wealth is, what they are. So APS Wealth is an authorized independent financial service provider. The company employs a number of highly qualified financial advisors assisted by a dedicated team of administrative personnel. As such, APS Wealth provides financial advice and intermediary services to corporates as well as individuals. And they do this strictly within the conditions of their Financial Sector Conduct Authority license, as well as in terms of the stipulations of the Code of Conduct of the Financial Advisory and Intermediary Services Act. In addition to the high standards of independent financial advice and estate planning provided by each one of their associates, APS Wealth thrives to secure access to cost-effective financial solutions that most appropriately match the financial needs of their clients. And one such associate of theirs is here with us today and is Kelvin Kruger, and he will be running the workshop today. So Kelvin Kruger is a financial planner at APS Wealth, as I've already stated. After finishing his BCom economics degree at the University of Pretoria, Kelvin started working at Pentagon Financial Solutions as a representative under supervision for 2 years while gaining his industry experience to become a fully approved representative. During the first few years, he completed the RE 1, 3, and 5 regulatory exams required by the Financial Sector Conduct Authority and finished his postgraduate diploma in financial planning through the University of Stellenbosch. Being an independent wealth planner, Kelvin holistically evaluates clients' financial needs and helping them pinpoint key growth areas for generating a sustainable long-term financial plan. When looking at tailor-made financial solutions, he believes that regular communication is the key to understanding the ever-changing economic landscape. He does this by reporting to clients on a monthly basis to keep up to date with their personal planning and investment portfolio for them to ultimately make ongoing informed decisions to reach their financial goals. So that is Kelvin Kruger, and he will be running the workshop today. So over to you, Kelvin.
Thanks, Alice. I appreciate your introduction, and thank you for the opportunity to be able to present today. I'm going to do a screen share. I'm going to keep my video off. I don't know, do you prefer my video off or do you guys want my video on? I can do a quick hello session and then I can go off the video and I'll do my slides for you guys on there. So I'm going to stop video. Just give me an opportunity to do a screen share with you guys. Can you guys see the presentation? Great.
Yes, it just popped up.
Okay, great. Perfect. So yeah, thank you very much. And a very good warm welcome to all the girls from G4G. And thank you for Rita for actually giving an opportunity to do this presentation. So basically, I think Alice did a wonderful job of introducing me, but I also included a little bit of a bio just on the background. Before we start, I would like to introduce myself. Obviously, my name is Kelvin Kruger, and I'm an independent financial service provider representing. Sorry. Sorry, guys. Trying to find you guys seeing my presentation in presenter view, or is it just in normal view? Sorry, Alice.
I was trying to unmute myself. It's in presenting, not necessarily in the moment. So we can see what's going to be on the next slide.
Okay.
Yeah, so it's not full screen.
It's not on a full screen. Okay, apologies for this. I will just try and get my settings right. It's the first time I actually do it in presenter view and not just in a normal view. Okay, sorry guys, I'm just going to go out of presenter view and do the presentation without that. Let me quickly just do this. There we go. Apologies for that hiccup. So yes, basically the discussion points for today would be what is financial planning, how to create a financial plan, how to set up a budget, essential versus non-essential expenses, expense tracking, credit score, different savings vehicles, and then compounding interest. Now, it's very, very important when you look at financial planning to obviously set up a few financial planning goals. And it's very, very important to look at, certain elements of how to draft these plans. Now, it's very important to look at, a step-by-step process. A financial plan is a document containing a person's current assets and liabilities and long-term monetary goals and strategies. And today we would like to just focus on, how to draw up a budget and why is it important to team up with a financial planner that can help you, distinguish between what is essential and non-essential expenses, and also then to make sure that you are equipped to make informed financial decisions going forward. So basically, a few things that we would like to touch on today is how to set up a budget. I know it can sometimes sound, very simple, but it's not always as simple as, just drawing up what you are spending every month and what you are earning. Now, this is an example that I've actually drafted up to say, what is your different income, your salary, your rental, even if you have rental income, how to add that up into a budget. And then important is what is deductible expenses that you will incur on a monthly basis. And what is very important to note with your expenses is what is essential and what is non-essential expenses. And then obviously what is disposable income at the end of the month, which you can then spend on yourself or actually save. So what it comes down to basically is expense tracking. Now, it's important to list all your expenses every month. And like I said, essential and non-essential expenses is very, very important. Writing them down in an Excel spreadsheet is very important because at the end of the day, if you do not have a track record of what you're spending, you will not know when you're overspending on your monthly budget. And then it's very, very important to reconcile your expenses and make sure that you try and achieve your next month's budget if you didn't make it on this month's budget. Now, very, very important, essential and non-essential expenses. If you're looking at non-essential expenses, clothing, obviously non-essential, shoes, makeup, video games, gym membership, and then, yes, of course, your Netflix is also a non-essential expense, even though one might feel that it is a essential expense. And then your essential expenses would be your mortgage, vehicle financing, insurance, utilities, groceries, medication, and tuition. Now, very, very important to look at a credit score as well. A lot of, students ask me, how do I get a credit score? What is a credit score? Now, a credit score is a 3-digit number that calculates using your credit report, and it is determined by the amount of debt that you have basically incurred and the way that you repay this debt. Now, there's a nice website that you actually can go and check your credit score on. The website is basically called ClearScore. Now, ClearScore, how that works is you can basically enter your information on this, your personal information on this website, and it'll give you a credit score rating. Now, why it's important to have a credit score is as soon as you approach a bank or financial institution to borrow money, they would like to do a credit check on you. And with that credit check, they can determine how much money you are allowed to borrow and how much they can basically lend you. I will open up this link and do a screen share on the ClearScore. It's a very nice website to actually engage in and actually go and have a look at what is your personal credit score. So on the ClearScore website, you can say what is your credit score, and you can create a profile. And on this profile, you obviously add your personal details and you log in. And there's a few personal questions that you need to answer for them to do a credit score check on you. Now, when you get your credit score checking, this immediately gives you feedback on what your existing credit score is. And financial institutions have direct access to all of this information. And it's very exciting to actually have a look at this website and see where you are currently standing with your credit score, and if you are able to borrow money or qualify for taking out a loan at the bank, etc. So that's something that I think it's very important to take note of when you want to actually go for financing a vehicle or financing a house, is to make sure that you know what your credit score is, and it's important to have a look at what that scoring entails. And then moving on, obviously it's important when you're looking at a budget, what is your essential and non-essential expenses, but your disposable income you can then spend in a certain manner. And it's important to obviously look at different savings vehicles. And the savings vehicles that you can utilize currently is as follows. Obviously, one can open up a bank account and save money in the bank, but currently the interest rates in banks are very, very low, so the returns aren't necessarily that good. Unit trust investments, like voluntary investments, is more lucrative investment asset class where you can actually open up this investment, save money with specific savings goals, and then have these goals set out. So when you want to buy a house or when you want to buy a car, you can actually make withdrawals out of these investments. One investment that I really want to go into detail on today is the tax-free savings account. I'm also going to explain a little bit of an example of compounding interest and how that works in practice. But a tax-free savings account is really one of the best investments that young individuals can make these days. And obviously, looking at the different range of investment portfolios that you can invest in, it's very good to look at investment vehicles that actually accumulate tax-free and that you can utilize or draw income out of those investment vehicles the day that you retire without having to pay any taxes. And then important retirement savings like pension fund or retirement annuities. It's also very important to look at those elements of saving, not only for saving for retirement, but making sure that you actually save money in these vehicles for tax deductible purposes. And we'll get into that in a later stage in the presentation. And then obviously another vehicle is direct shares, how to buy direct shares. I know there's different platforms available in South Africa to buy these shares, like easy equities, direct share portfolios. It's also very good to diversify and have your own little share portfolio. And that is why I usually advise speaking to financial planners or independent financial planner to help you to select these shares and set up these different investment accounts, and obviously then evaluate these goals that we had discussed earlier for retirement. And then very important also property investments. I'll go into a little bit of a discussion on property investments. What is a property investment, and also what to look out for when you're investing in property, if it's a primary property or perhaps if you're looking at a secondary property for investment purposes. Is it really such a good investment, and what to look out for? And then very important, an example that I want to give today is what is compounding interest, how it's calculated, and how it basically works in practice. So here I've used an example of 3 individuals that started saving 3,000 Rand a month in an investment account. And this investment account will then accumulate, let's say, for instance, with inflation or 5% return figure. But if you look at the long-term figures and the illustrative compounding interest, is the sooner you start investing, and the higher the amounts will be over time, because it is interest on interest. And that's where the term compounding interest comes from. But in this example, you'll see that there's 3 individuals, and the one starts saving 10 years before the other, and in 5-year increments. And you can see how important it is, and what the compounding effect would be if you start 10 years before any of your peers. And that's why it's so important to look at investing in investments that can provide compounding interest effects, and looking at your different vehicles that I discussed earlier. You can generate compounding interest in more than one investment vehicle. Retirement annuities, voluntary investments, tax-free savings all work on the basis of compounding interest. And the underlying investment portfolios that you select, or shares that you select in your portfolios, those elements actually grant you that compounding effect, and it determines the percentage of growth that you can accumulate. Now, a very interesting fact in terms of the tax-free savings account. Now, just a little bit of a background on this tax-free savings. It is an account that launched in 1 March 2015, and this account you can open up as a South African resident. You can open up more than one tax-free savings account, but your annual lifetime as well as annual contribution limit is 36,000 Rand per annum, and then 500,000 Rand in your whole life that you can invest in an investment like this. Now, I know investing 3,000 Rand a month is a very tall order, but I use this example as if you can maximize this contribution limit, and what happens with the compounding effect over time if you end up in a position where you can actually contribute the maximum contribution. Now, I use this example of CPI plus 7, which is roughly about 13% growth. It's not an unrealistic growth figure, because if you look at what the JSE has done since inception, you're basically looking at an average return of about 12 to 13% since inception. So I just use it as an example and an illustrative value. But if you look at if you look at investing 3,000 Rand per month in a tax-free savings account over a rolling 14.5 years, that will be the time period to maximize your tax-free savings account, and you're getting 13% growth on this investment, you can accumulate roughly about in excess of 40 million Rand in an investment account like this. The valuable thing about an investment like this compared to a bank investment or a voluntary investment is the fact that all this growth is tax-free. Now, not a lot of income streams or growth that you accumulate in South Africa is tax-free. Even if you accumulate it overseas, you'll be taxed on foreign interest and foreign dividends. So it's important to try and open up investment vehicles that you obviously don't get taxed on over time. And in South Africa, the tax-free savings account is one of the few investments you can open up that will accumulate tax-free. And as you can see in this example, the compounding interest effect of an investment like this, if you do not make any withdrawals and there's only contributions going into this, you can accumulate, roughly about 40 million Rand. And the term basically compounding interest, you can see on that growth figure, you can basically double your money every 5 years if we're working on those assumptions, which is quite valuable if we take into consideration that this investment vehicle is tax-free. If we compare this to a bank investment or an investment in a voluntary portfolio, for instance, voluntary portfolio is a capital asset, so you'll pay capital gains tax, which means you will be taxed on the growth of your investment. An interest investment in the banks, you'll also be taxed on the interest you've incurred on that investment. So there's always tax involved when looking at different investment vehicles. Even in your pension fund or a retirement annuity that you're investing in, you will be taxed eventually when you draw money out of those investments when you retire. So this is a great vehicle, not only for shorter term goals, but also for retirement goals and accumulating money without having to pay tax on the growth. And this is basically the example that I wanted to go through today is, what is a tax-free savings account? What type of investment vehicles is available in the market? And also, why do you need a financial planner to set up these different savings goals, and to determine when is the right time to buy a property, or when is the right time to actually to buy a car, or for instance, go on an overseas trip. These are all elements that you need to build into a financial plan, because it's not something that you can necessarily just fund out of your monthly budget. You have to start saving, and you have to set up goals. And that's in a nutshell, basically what a financial planner does. And how financial planners actually help their clients, not only with investments, but also with insurance products like medical aid, short-term insurance, long-term insurance like life insurance. All of those aspects are things that you need to consider when drawing up a financial plan. Now, I wanted to keep today's session more interactive, and that's why I didn't bring in too many slides, too many boring, examples and stuff like that. I would like to open the floor to anyone that would like to ask some questions regarding financial planning. I have a few questions that I received from the team at G4G that we can discuss. But I believe that this is a topic of discussion, and a Q&A session is usually your best learning curve when it comes to financial planning. I know there's a lot of jargon and there's a lot of words that I've said today that might not resonate necessarily, but one can always have an open discussion, and perhaps putting it into a form that you guys can understand. It'll be great to open up the floor in terms of discussions and chat group. I don't know if Akka, if you would like to open up the questions and answers. I do have a list with me that I can go through, but you guys are more than welcome to post questions in the chat box, and I can read them out aloud, and we can go through those.
Good morning, everybody. My name is Aga Lamini. You can call me Akka, though. Please put your hands up, and then we'll take the questions, guys. This session is meant to help you plan your futures. Just put your hands up and ask away. Okay. Musa, would you like to turn on your camera, please, and ask Calvin the question?
Okay. Hi. So good morning. So my question relates to the credit score. So in order to basically accumulate a good credit score, does that mean I have to have a basic set of monthly expenses that I need to pay every month?
Good morning, Mosa. Thank you for your question. Yes, it's a very important one. If you're looking at a credit record, at the end of the day, the Financial Bureau only have access to basically your credit score, and that is what they base what they can lend to you. And things that will increase your credit score or better your credit score is necessarily taking out credit. So for instance, having a opening up a credit card, having a account to buy things on credit. But it's very important how you manage this credit score, because you can actually hurt your credit score if you do not pay back your monthly repayments on your let's say your credit card. That can negatively impact your credit score, and with that lower credit score, it will impact the way that financial institutions will grant you credit. So if you phone in and you ask for a credit card, the bank will actually tell you what your allowance is in terms of that maximum credit, and they base that calculation on what your existing credit score is. So to answer your question, it's good to open up certain elements of credit and to buy things on credit, but it's very, very important how you manage it. If you can pay back your credit in a fast fashion and pay back more than what you owe every month, that will actually increase and help your credit score. Credit is sometimes a very tricky one, because at the end of the day, people end up misusing the credit that they have, and they default on their monthly repayments because they don't have enough money to repay that credit, and that can really badly hurt your credit score. And that's the reason why I actually brought it into the conversation today, is go and have a look at your credit score and find out on the website, on ClearScore's website, how can you improve your credit score, and what can you do as an individual to increase your credit count so that you can constantly make use of credit facilities. It can count against you, so be very careful how you manage credit, and ultimately the effect is that you need to eventually buy things on credit to build up a credit score, but be very vigilant on how you manage your credit. I hope I answered your question.
Yes, you did. Thank you very much.
It's only a pleasure.
We have a question from Lwazi. Lwazi, do you mind just turning on your video, please, and unmuting yourself?
Hello, how are you? Sorry, I can't turn on my video.
It's fine. You can just ask the question like that.
Yes. My question is, I don't know if you've touched on unit trust. Maybe I joined in. Can you guys hear me?
Yes, I can hear you.
Yes, and I also wanted to ask other savings or investment method that one can use that have compound interest. Because I think I heard you say that investing in a bank does not give you that much interest, because is it like a simple interest account or what? I don't know if I'm making sense.
Yes, no, that's a very valid question. So to answer your question, I didn't go into too much details on the specific investment vehicles. That will be an ideal conversation with a one-on-one financial planner. I am a financial planner, so I can set up one-on-one meetings with every one of you guys that are interested in finding out more about what investment vehicles are available. But just to summarize it roughly, banks currently, you can open up a savings account with a bank. So we can open up a savings account with APSA or with Nedbank or with Standard Bank, and they will usually have a name for that account. So let's say it is a money market call account, or it's just a normal check account. Now, usually normal check accounts do not have interest on them. So if you've got money in your check account, it will barely carry any interest, if any. If you have a surplus money on your credit card, for instance, there will be a small element of interest, but it usually is very low. And currently, if I'm saying that we are moving into a low interest rate environment, it means that currently, the Reserve Bank sets inflation targets between 3 and 6%. So that's what they want the inflation to actually accumulate by every year. Now, if your money is not growing above inflation set as the targets, it means that you're technically saving yourself poor. And that's where investments in the bank can sometimes be destructive, because if you're not getting more than inflationary returns in the bank, that means that you're technically getting poorer every year, even though you are saving. So that's why I advise some of my clients to look further than what banks provide you with investments. Look at a voluntary investment, for instance. That's like a unit trust account where you have a fund manager that actually manages those investments. They do the selection of the funds, and that's what we at APS do for our clients. And then at the end of the day, you can, over time, reach performances above inflationary figures. And that's the idea of having a financial planner and having fund managers managing your portfolios, is to try and beat inflationary figures that the banks can't necessarily do. The one thing is obviously inflation, but the other thing that I explain to my clients is real inflation is even higher than what current inflation is. Now, real inflation would be, what is the inflation we pay? So basically, if we go buy our goods at Pick n Pay or at Woolies or Checkers, those increase in prices are not always between 3 and 6%. Sometimes it can run at 10% per annum. So that means that your investment portfolios needs to grow in excess of this to sustain your current consumption if you're not earning more income. And that's the problem with saving for retirement. A lot of people think they save enough money for retirement in a retirement annuity or in a voluntary investment, or even in the bank. But at the end of the day, inflation catches up with your money. And if you only saved in the bank, the probabilities are very high that you will not necessarily be able to maintain your living standards. And that's why you need other investment vehicles. But those specific investment vehicles like buying shares and, you know, opening up a unit trust or a tax-free savings, that you guys are more than welcome to discuss with me on a one-on-one session. I can do our consultations for free. We can have a discussion on those, and we can go into more details on how to open up a unit trust and, you know, what type of funds can you select in these unit trusts. So basically what it comes down to is one has to have more than just a bank account. You must look at other investment options, because inflation can actually hurt you in the long run if you're only saving in the bank. I hope I answered your question.
Yes, you did. Thank you very much.
It's only a pleasure.
All right, we have a question from Nikita. Nikita, would you like to ask your question? Unmute yourself and ask the question.
Morning, everyone.
Morning.
Can everyone hear me?
Yes, we can hear you.
Okay, thank you. Yes, I would like to ask if sorry, I'd like to ask which bank is currently doing great for one to open tax-free savings account, and okay, and is the interest on a tax-free savings interest you earn for saving money?
Okay, I didn't hear you clearly, but I'm just gonna try. Is your question?
Calvin,
Yes.
she said, which is the best bank to open a tax-free savings account, and can you earn interest on a tax-free savings account?
Okay, thanks, Aka. So yes, very good question. You can open up a tax-free savings account with a bank, or you can open up a tax-free savings account with a financial institution. Basically, what we do is we help our clients open up tax-free savings accounts on investment platforms. Like, for instance, 91, the old Investec Asset Management, is a specific investment platform. Just like you get a bank, you get an investment platform. Alan Gray is a common name that you might have heard of. We use Collective Investments as an administrative platform. And on this platform, you can then open up a tax-free savings account and invest in a range of different funds. But you can also open up a tax-free savings account with a bank. And you guys will most probably have heard over the news or on the radio or online that you can open up a tax-free savings account through your bank. But it comes back to this discussion we had earlier on why would you open up a tax-free savings account with a bank instead of opening up one with a financial institution, and why not? Now, my opinion is that if you open up a tax-free savings account with your bank, you're still going to sit in the same interest-bearing accounts. So banks cannot really they give you a fixed interest rate, but they don't necessarily give you an interest rate higher than real inflation. So technically, if you're saving in this investment account that you don't want to draw money out of because the growth is tax-free, you're going to not outperform inflation, which means at the end of the day, you're going to save yourself poor. And that's why I advise opening up a tax-free savings account with a financial institution, investing in shares, listed property, and a basket of different asset classes that can over time outperform real inflation. So yes, to answer the question, you can open up a tax-free savings account with a bank. I wouldn't necessarily advise that to my clients, but it is possible. And if you have opened up a tax-free savings account, for instance, with your bank, you can always transfer that account from your bank to a financial institution like CI, which is Collective Investments, or 91. You can transfer that to an investment platform and then select shares with your existing tax-free savings account at the bank. So a big question that I usually get from students is, I've opened up a tax-free savings account. I didn't know how to manage it. No one advised me on how to use this investment and not draw out of it, but there is still money left in this account. What must I do with this? Must I now open up another one, or must I transfer it? My advice is get everything into long-term growth assets on an investment platform. Don't open it up with a bank with an interest rate, because after fees, you are not going to outperform real inflation. And if you have an existing one, speak to a financial advisor to transfer that into a portfolio that can beat real inflation over time. Remember, this investment is a 40-year time horizon, because if you don't draw out of this investment, all the growth on this investment is tax-free. So if you can limit yourself of drawing and just invest for 40 years, for instance, growth that you accumulate on this investment is astronomical, and it can really help you at retirement to actually draw an income that you do not pay a cent of tax on. I mean, your income that you're earning when you start working, that is taxable in your hands. Your retirement annuity is taxable. Even the interest you're getting on your investments in the bank is taxable, but a tax-free savings account is not. So my answer to you would be, you can open up one with any financial institution. You can have more than one tax-free savings account, but you cannot exceed the limits of 30,000 Rand per annum and 500,000 Rand in your lifetime. So if you put in a 500,000, you must leave it. You cannot contribute. And very important, with this tax-free savings account, if you make any withdrawals, you can never replace the capital. Now, just to put that into an example, let's say you invest 30,000 Rand in your first year and you take a 10,000 out of that, you can only still invest a 470,000 because you already invested 30,000. So every time you invest, your 500 lifetime limit decreases. And if you make withdrawals, it doesn't reinstate. You only have a total of 500,000 to invest in this account. If you withdraw, they don't reinstate the total. So it's important, use that 500,000 Rand wisely in your lifetime. Even if it takes you 30 to 40 years to get 500,000 in there, try and resist the temptation to draw for short-term needs. Leave it there for retirement purposes, because this will be your most valuable investment that you can make over time.
Thank you so much for explaining that. I never thought about opening a tax-free a financial institution. Actually, I never thought that was possible. That was the thing.
It's only a pleasure. And as I mentioned earlier, you guys are more than welcome. I'm going to leave my details. I believe Alice and Akka will distribute it amongst yourselves to send me a direct email or schedule a Zoom meeting, and we can have a one-on-one conversation and with examples and quotes on how it works and what the costing is, because it isn't necessarily as expensive as people think. You don't have to pay huge amounts of fees to get a financial advice or to get an advisor to help you on your journey to open these accounts and save over time. Great. Is there any other questions?
So, Akka, you have your hand raised. I don't know if you have a question.
I have a question. Halvin, you're accredited, but people don't really know where to look for somebody who is qualified to do these things. There's a lot of scammers in South Africa. Could you perhaps direct us on where we can look up, somebody who's accredited? Is there a directory or something?
Very good question, Akka. There is a directory of certified financial planners. So it's the FBI's website. So FBI, Financial Planning Institute of South Africa, where you can actually go and look up for, I wouldn't necessarily just use any financial planner. For instance, you get bank brokers or people working from home. I usually advise people looking at someone that has gone through the qualifications of financial planning, at least doing the post-grad in financial planning, and then definitely looking at someone that can fit your personality profile. It's very important. A lot of people look at financial planners, and the average financial planner in our industry is about 55 years old. So teaming up with that older financial planner is not really going to help you achieve your long-term goals. You need to select someone young. But when looking at someone young, they're obviously lacking in some experience. And that's why I advise, if you're looking at a young financial planner, get someone that's qualified and that has the FBI designation and did the postgrad in financial planning. That's the first step. And the second one is do a personality testing. Not everyone gets along with any financial planner. Make sure that you get someone that you can trust and that can build a trustworthy relationship over time and explain the things in a manner that you do understand. But yeah, very good question. Don't just use any financial planner. And the one term I usually advise everyone to look at is independent financial planner. There's a difference between a tied agent financial planner and an independent financial planner. A tied agent works for an institution like a bank. They need to sell those products. They have specific selling targets every month. So they need to sell you a product. Where an independent financial planner like ourselves, we do an analysis on our clients. We do a financial needs analysis and a medical needs analysis to determine what you need as a client. And we won't necessarily put one product above the other because of a commission-driven, sales-driven aspect. We look at what the product has to provide for our clients, and we look at the cheapest possible option to get the best benefits. And that's why I say independent, because we are mandated to give advice on not only one company. We can give advice on PPS, Discovery, Momentum, Old Mutual, Sanlam. You can name them. If you're independent and you have codes with these companies, you can give advice on that. So very important, get someone that is qualified and get an independent financial planner. Okay, I think what we should also just try and do, I don't know if there is any other questions. There's a list of questions that came through, and I'm going to touch on a few of them. I think it's very important topics. I've had them in previous convos. I see there is a hand risen, so we're going to give attention to that now. I just wanted to touch on some of the aspects, but let's listen to the question first, and then we can go on to the questions that we've pre-populated.
So
was that for me? I just wanted to ask your views about getting a credit card and things like bank overdraft for an individual. Is that good or bad? Or does it depend on your spending habits, if you have good spending habits, or if maybe get a credit card and you know that you don't have control on what you buy? Like, is it a good or bad thing?
Okay, so what I'm going to do is maybe I can do a screen share to answer that question for you. And the screen share will then just open up the explanation here. The main factors that may negatively affect your credit score: a large amount of credit available, having lots of credit cards. So that will answer your question. Obviously, opening up a credit card is good for your credit score. But if you have 5 or 6 different credit cards with different institutions, that can hurt your credit score. And then applying for too much credit in a very short period of time is also not good for your credit score. Frequently changing your address, which is quite strange, but I mean, that can negatively impact your credit score. Court judgments, if you have any pending court cases, that can be negative. If you miss your payments, this is the worst one, and default on payments, you will definitely be negatively impacted. And obviously, if you go bankrupt and you don't have any income streams, but you still have credit, that can hurt your credit score. So you guys are more than welcome. I will also leave the link to the ClearScore website to go and read up on what negatively impacts this, what should you try and avoid, and what can you do to increase your credit score. But going back to your question on the credit card, you can open up a credit card. You must just be able to prove that you are earning an income. So you can't open up a credit card if you don't have a formal income stream and can prove to the bank. So that's the first check they will do. But be careful. Do not just open up credit cards because you can, because if you open up more than one credit card or in a very short period of time, that can negatively impact your credit score.
All right. And then we also have a question from Rihanzu. You have your hand up.
Good morning, everyone. Can you please elaborate more on property investment? What is property investment?
Thanks.
And how can...
Thanks, Ranza. I was actually just going to that topic on the Q&As, and I think I'm going to jump in on that question. The one question that I had here is, what is property investment and how important is it to get started on acquiring property? Now, I've had this discussion over past, few webinars, and it always arises on what to do with property. Now, just to shed some light on how property works and the taxes around that, it's very important. So if you buy your first property in South Africa, they call it your primary residence, and your primary residence has a 2 million rand capital gains tax exemption, which means that if you sell your primary residency for a profit, you will not pay tax on the growth you've made on that property. So that's very, very important, because when you look at property investments, let's say you want to buy a flat and rent it out to someone, or a house and you want to rent it out to someone, is that a good investment or not? Now, if you ask a financial planner to punch the numbers like myself, I would say there are certain property investments that can yield good growth, but is a lot of risk factors involved, not for primary residency purposes. Now, if I say speculating purposes, it's obviously buying to rent or buying to sell. Now, if you already have a primary residence that you stay in and you buy external property to sell, you're going to pay capital gains tax on the growth, because only your primary residency has a 2 million exemption, not your secondary one. But if you buy a secondary property, what are the elements to take into consideration when you buy this property? First of all, transfer duties, levies and taxes, all of those things needs to be taken into account, because a big mistake a lot of people make is, let's say you buy a property, 500,000 Rand for a property, and you rent this property out for 10,000 Rand a month. That 10,000 Rand a month will form part of your income for taxable purposes, which means is SARS will look at your income that you're receiving from your employer, and they will add your rental income to this, and you will pay tax on the total amount, which means a lot of people don't take into consideration you might take off a 30 or a 45% or even a 20% for taxes at the end of the month, because that's you need to pay on the rental income. Then you need to maintain that property. So that property, you know, people that rent from you don't always look after your property like you would look after property if you own it. So they might break things. You need to replace that. Yes, you have insurance, but insurance needs to pay a premium for every month. And that is a deductible expense that you need to take off when calculating how much profit that you actually make out of renting this property. The second thing with property is location. You can buy a property, and if market starts tumbling and you bought in the wrong area, the value of your property can actually decrease. So you can sell your property at a loss. It's not always such a good investment. And then the final nail in the coffin for me as a financial planner, why I'm very, very reluctant to advise clients to buy property for speculative purposes, is in South Africa, we all know that we have a backlog in our legal system. And what this means is, if you have a tenant in your property that needs to pay rent and they refuse to pay rent and say, I'm not going to pay your rent anymore, take me to court, it will take you at least 9 months to get a court order to actually evict someone from your property. So for 9 months, you will be paying for a property, a mortgage, and you will not receive rent. And that will then incur extra legal fees as well. So all of these aspects you need to take into consideration. What can go wrong? Because if it goes wrong, you are still sitting with that mortgage. You still can't default on that because it will negatively affect your credit score. So there's a lot of elements that is risky when buying property, but don't quote me and say, Calvin said I shouldn't buy property. There are certain good investments you can still make in property. If you buy in the right location and you restore a house and you sell it as if it was your primary residence in a short period of time, then there is certain ways you can get around your 2 million exemption and make money out of property, definitely. But buying and renting out is dangerous in South Africa. You don't always know who you're dealing with. And unfortunately, after your tenants don't pay, you're sitting with legal fees and probably default on your mortgage payments. So that's one thing. And then very important, I mean, you can't just rent. So one needs to look at when are you going to buy. And that's why it's important to sit with a financial planner to say, when are you planning to buy a property? How are we going to go about to open up a savings account specifically only for putting down a deposit on a property? And what type of properties can I afford? What locations are good to buy? Because if you're buying a primary residency, you want to obviously have your own property to live in, because you don't always want to finance someone else's property so they can pay it off. But there is a time and a place for everything. One can't just say, I want to jump in and buy with my first paycheck, I want to buy a property. One has to go through the whole budgeting analysis to determine what you can afford and to plan for worst case scenarios, because a lot of people only plan for best case scenarios. They always plan as if they won't lose their job, or that they won't get a pay cut because of COVID, or you won't get a tenant that's not going to default on payments. Those are all elements that you need to take into consideration with property. I think I've covered most of the things I wanted to say on property investments. Property is good. Get a primary residency as soon as you possibly can. Make sure you buy what you can afford, and be very careful if you buy property for investment purposes, to sell or to rent out.
Thank you.
Yes, Alice.
So just a question I just want to take up on the property. So you mentioned more on the residence side of property in terms of like having tenants who stay in the particular property. So then looking at the commercial side of property, say office space, would you then say that would be probably better to more invest in as opposed to residential property?
Sorry, Alice, just repeat that. I think you were breaking up on my side. I didn't hear the question clearly. You're just going to repeat it. I'm just going to put my volume up as well.
Okay, so I'm asking the difference between residential property and commercial property. So in terms of office space, would you say commercial property, it's much easier to deal with as opposed to residential property where you may have issues with tenants and evicting tenants?
Yes, Alice, that is a very valuable question. Obviously, we have a office scenario. We also invest in commercial property because we have offices in Johannesburg, Pretoria, as well as in Cape Town. But to apply this, you know, a commercial property, the benefits that you have there is usually you work with a commercial property broker. And those people are usually, you know, tied to a specific agency. For instance, CEF or Remax, they have tenant agents. And those people are then responsible for collecting your rental income, but they don't come cheap. You will pay between 8 and 10% commission on your rental income, for instance, just to have someone like that. And they have their own legal team that will fight the legal battle. But at the end of the day, we're still sitting in South Africa. Even if you have the best legal team, the courts are backlogged and they are going to wait to fight for the case. So you're still sitting with the same problem that you're not getting rental income. But like buying an office space to work in yourself or to do your startup in or to expand your business, that's a very good investment to make, because commercial rent is way higher than renting a property for accommodation purposes. And that's important to take note of. If you do invest in a property, there are certain property it's called syndicates, but syndicate, it sounds such a negative term. It's actually funds that you can invest in, where they invest in property developments, commercial, for instance. So there are certain listed property investments you can make within your investment portfolio. So if you speak to a financial advisor and you're constructing your portfolio, there's a certain element in those portfolios that have exposure to commercial property. That is a much more risk-averse way of approaching property investments than trying to put your own money into a property. That's managed. There's a board of directors, and your money, there's liquidity in there as well. So if that property syndicate for some reason loses value, you can take whatever is left of your capital and you can take it out and withdraw it. If you're stuck in property, like if you're buying it yourself and you want to sell and the markets are fell, you need to first find a buyer. And finding a buyer in a bad market can lead to a loss of your investment. So I hope I answered your question on the commercial property side. Yes, if you work with an agent, it is easier to get your rental income, much more convenient because you don't have to knock on someone's door for it. But bear in mind, we're still dealing with South African legal factors, and that can influence your rental income, even if you do have an agent working on your property.
Okay, thank you. And just one last question in relation to property.
Yes.
So would you say which investment would be more stable and much more probable to have the best growth, so to say,
Yes.
between share investment and property investment, and which would you say has less risks?
Okay. So let's look at a holistical financial planning, and that's also how I approach giving advice to my clients. The biggest word to take from that question is diversification. So diversification means have a bank account, have a voluntary investment, have a tax-free savings, have an RA that is all exposed to different shares, different listed property, different bonds. So make sure that you diversify and have something in everything, but not everything in one thing. So you know, and if you do go into an investment class that you do not understand, make use of professionals. Don't go and buy a property because you've read our property is a good investment and you've read it's in a good area. Speak to someone that can guide you. Speak to a financial advisor, because they can highlight all these things for you. And the way I approach it is, when I construct portfolios for my clients, we build portfolios that are so diversified. Just to give you an example, so we all have heard of the Steinhoff debacle that went down and the shares plummeted and Christo Wiese lost a lot of money, and it's very applicable. Now, if you invested in those shares at that time, you would have lost most of your capital. And there's people that lost millions of rands. But for instance, our portfolios and most other portfolios like Allen Gray and Coronation and Old Mutual, they diversify some of their portfolios. And for instance, our portfolios was only exposed with a 2% exposure to Steinhoff when the Steinhoff crash happens. That means that you didn't actually even feel the effects of the Steinhoff debacle because all your eggs wasn't in one basket. And that's the principle I apply to other investment vehicles as well. Diversify. Don't just have one account. Have 3 different accounts. Have 3 different accounts that have different goals. Even structure different goals within that account: low risk, medium risk, high risk. Name your different accounts. So those are all things you can sit and do with a financial planner, is create these different goals and these different accounts. But to answer your question regarding property and equities, there's not one that's necessarily better, but if you have you holding both, a little bit of both in all your portfolios, in the long run, you will make money. But if you over concentrated in one specific asset class is property or asset or bond, or interest in the bank, that's one property class. If you're only holding one property class, that is exposing yourself to too much risk. Diversify. Buy a primary residence, have an investment portfolio, have a tax-free savings, and build up a portfolio of different investment vehicles that invest in different asset classes.
Okay, thank you. So basically, don't put all your eggs in one basket.
That's it. That's the term what we're looking for.
All right. Adashula, I have your hand.
I have 2 questions.
Right.
So you briefly touched on naming your accounts. I read somewhere recently that you actually more likely to save and not touch that savings account when you name it. Is that true?
Well, at the end of the day, clients have the full discretion on their own money. So if they want to withdraw, they will withdraw. And you know, some people end up withdrawing unnecessarily from an account. But yes, the question that you have is very applicable, because I've seen time and again with most of my clients over the years that if you save all your money in one account, in one voluntary account or in one bank account, you end up spending money that you would have wanted to use on something else. And that's why I have, on, for instance, my voluntary portfolios with clients, I have actually created a deal structure. And I want to actually draw up an example and show you guys how it works. I'm just going to go through a few of my emails just to have a look at where this is, but it'll give you an example of what a voluntary investment account looks like, and then how do we structure this to actually accommodate different deals in this investment account. So just give me 2 seconds to draw this up. Okay, so I'm going to do a screen share. So this screen share, basically what it entails is you can see here that basically any one of my clients actually receives a statement like this with your details on there. And then also every month, the growth that you've accumulated. Now, this is a basic example. Client just invested 100 Rand. By the way, you can invest only 100 Rand or 50 Rand in these investment accounts. And you will see that on 91's platform, the investment has an investment number 538756/1. Now, you can actually create the same investment number with a /2/3/4, and every one of these different investments can invest in different funds. So you can have a low risk, a medium risk, a high risk, and every one of these investment funds or deals are there for different investment purposes. Which means if you want to save for a house, you can do it in deal 1. If you want to have an emergency fund, you can do it in deal 2. So you can create different savings goals. And that's basically what I would advise looking at when you speak to your planner is give him your different goals that you want to use. Don't just give him an amount to say there's 2,000 Rand or 3,000 Rand or 500 Rand. I want to put it into your account, and then whenever I want to use money, I'll just draw it out. Have a specific goal, and that will also guide you in when is the right time. Because another question I regularly get from clients is, Calvin, when's the right time to buy a property? When's the right time to buy a car? And that can only be answered by how much money do you have available to buy a car? How does your cash flows look? So you'll only know if you have specific savings goals to say, okay, I have enough money in this account to buy a car now. So let's go look and shop around. But it's very impossible to distinguish between your financial planning goals, your savings goals, if you don't break it down into different deals. So, okay, I hope I answered your question there, but it is possible to not only invest, but also to break your investment down into different deals, and important, taking different risks. Because why do you want to take different risks in your portfolio? If you can save for the next 10 years for property, you can afford to take a little bit higher risk, because if markets goes south and gets volatile, then basically in the short term, you can lose capital. Your money can decrease in value. But if you have a shorter term goal, for instance, you want to go overseas in the next 2 years, you don't want to take as much risk because you don't want your investment value to fall. So you're going to take a low risk investment. And that's why it's important, not only for specific goals and the timing of those goals, but the amount of risk you take in any one of those goals.
Thank you. And just a second question.
Yes.
I saw that Old Mutual has this application called 22/7, and
Yes.
I was reading up on it, and it sounds good, but what are your thoughts on it if you've heard of it before?
I've heard of it. I have my own account as well. Me, being a financial planner, obviously, if these new things come out, I download it and I set up a profile for myself and see how it works. It's great for expense tracking. There's other apps available as well to track your expenses. There's a lot of apps on the App Store available to do that. The nice thing about the 22/7 app is the fact that it pulls through on your bank accounts. So whenever you swipe your card, it comes through there. So for that purposes, it's great to track your expenditure. But I have found that the best way for me and for most of my clients as well to track expenditure is for keeping your expense slips every month. Now, it's something that I wanted to cover in the presentation, but I rushed a bit through that. But if you can keep all your expenses at the end of the month, literally keeping every slip that you get from your grocery, from eating out or going to the movies or renting something, keep all that invoices and the slips, because it's going to give you a good habit to, in the future, use that to your advantage, because your tax consultants will need that eventually to submit it to SARS so that you don't pay unnecessary taxes on some of your income. So very important, keep track of your expenses on Excel. That will help you with your tax as well. 22/7 is a great app. 24/7, it's 22/7, and it's a great app to track your expenditure, but it's sometimes, for me personally, it's a bit complicated in the sense it doesn't simplify everything, because it's very hard to draw in all your different profiles. So let's say you've got an investment with 91 and a bank account with Standard Bank, and you've got it with different financial institutions. It's very difficult to draw everything in and to get accurate figures on spending, because you always end up missing one of the companies, or a specific company that you invest in doesn't pull through on the app, and then you can't have accurate figures on your budgeting. And that's why a manual budget with an Excel is much more effective, because you don't miss a lot of things, and keeping the slips, you don't miss a lot of things. But further than that, the 24/7 app only gives you some pointers on advice on what is specific savings vehicle. So you can use the app for that purposes. But I think the app is still very much in beta phase. They are trialing and testing a few things. They're obviously using the platform to try and sell their products as well. And they're combining that with the budgeting and expense calculator that they've built into it. But play around with it. I always say one will only know when you play around with it, but don't rely too heavily on the data that you're getting from the app, because the best data you can generate is by keeping everything, all your slips, and doing your own Excel spreadsheets. I think there was a few other questions that we set out. I'm going to touch on one or two or three of them. Was there any other questions that you guys...
There's a question in the chat box.
Yeah.
Nikita was asking if you've ever heard of the app called Easy Equities, and what do you think about it? Is it advisable to invest using the app?
Okay, great. That's also another app that's gained some traction recently. Very, very nice app. I've also got the app installed on my phone. I buy my own shares on this app as well. It's a great platform, but I wouldn't necessarily do my long-term investments on this platform. So how Easy Equities basically works in practice is you can play around on the Easy Equities app. You can basically build a model portfolio, and you can basically get an active portfolio as well. So you can actually put money into this investment account and then buy your own shares. It is obviously one of the cheapest ways to buy specific shares. But what I have found with some of my clients is they try and, do their tax-free savings accounts on Easy Equities, which I don't advise, because you cannot constantly every day look at markets and know when to buy and when to sell. So for your long-term investments, I wouldn't advise Easy Equities. But if you have extra money that you want to perhaps buy some shares with, a specific share that you really feel you love the share, you love the startup company, you want to buy into it, you can buy it on Easy Equities, and it's very convenient. It's very easy to use. You have an app on your phone, and you can track it on a daily basis. It is live, but like I said, just take money that you would like to speculate with. So I always use the example. If you go to a casino today and you decide, how much money am I going to spend in this casino? In the back of your mind, you know that the casino will most probably always win. So you're not going to put all your savings into that machine and try and win. The same with Easy Equities. Be careful when buying shares, because it can hurt you as well. You can lose all your money with shares if you don't know what you are doing. So be careful for Easy Equities. Great app, wonderful platform, good to use. If you just want to play around a little bit with shares, learn a bit about shares, go read up on shares. They've got links there to YouTube. Very nice, but don't open up your tax-free with the Easy Equities, and also don't try and put too much of your own money in these shares, because there's a reason why people are qualified analysts to do comparisons and manage portfolios. That they obviously hedging against risk and diversifying portfolios, where with Easy Equities is very concentrated risk that you're taking.
All right, thank you for that. I don't think there's any more questions, so we could possibly go through the questions that Aka had sent through.
Okay, so I'm going to touch on a few of them. I think some of the questions I've already covered in the presentation, and some have already asked questions, especially the property one. One question that I've received here is, how do I avoid lifestyle creep? I just started making more money and feel like I'm being reckless. Now, this is important, because I think most of us has been a little bit of reckless with money before, and that's why it's important to seek advice from a financial planner. And then the most important thing for me is do not live above your means. And the only way you can determine these means, because the word means is always, relative. If you want to really spend, you can think your means are higher than what they really are. But to determine your means, it comes back to what we did in the presentation on setting up a budget and be realistic about your budget. Don't just write the expenses you think you're going to incur. Take all your slips that you've spent money on in the previous month and include that into your budget. And then you can actually compare your budget to what you spent at the end of the month. And see if they gel, because a lot of people, they draw up a budget and they say, this is for food, this is for my insurance, this is for that. But at the end of the day, they don't bring into consideration all those unnecessary expenses that you just quickly bought something at the tuck shop, or didn't add it into your budget. So that's the way to determine your means, is if your budget is not if you're not getting in under budget, it means that you have to go rebudget. And if you're struggling with a budget, speak to a financial planner that can help you to distinguish between what is essential and non-essential expenses. And you will be surprised on how much more money you can spend less every month if you just try and stay in your budget. But the short answer to that is do not live above your means, and determine your means by drawing up a budget and comparing that to your expenses every month. So that was the first question. The second one is, do I really need to start saving now? I think that is a simple question for me to answer. Yes, definitely start now. It's the best time. Actually, yesterday is the best time to start. And saving is very important. If we look at, a lot of people think you need to start investing and saving when you have more money, or when you have cash flow, or when you have a steady flow of income. Those are all true, but at the end of the day, if you have money left at the end of the month, or if you have money that you're currently spending on specific items, there's always, something you can plan with. And these days, you don't need to invest thousands of rands in investment vehicles. You can open up an investment through APS, for instance, in a voluntary investment for 100 rand, lump sum. You can do, I've got students investing 50 rand a month into an investment account, and they're still getting their monthly reporting, like I showed an example to you guys, every month. And you can actually increase that debit order at any time you want, or just make voluntary contributions. So it's so easy to start saving these days. I think a few years ago, the barriers to entry on investments was much higher than today. So yes, definitely start as soon as possible, but important, speak to a financial advisor, someone that can break it down and explain everything to you, so that you understand it. And then there's another question. Okay, yes, this is a nice one. What should I do with my birthday bonus? I am tempted to throw a party, but I know there is a better way. Okay, so the answer for me on that one was to find a balance. Find a balance in saving and working out a percentage on what you can spend on this party. Now, parties are usually something that you don't necessarily need. I know sometimes we feel we need one, but it's not necessarily a need. And if it's not a need, you can have a specific percentage that you allocate towards something like this. So I would use an example of, let's say you use 1/3 of whatever you have earned, or a bonus, and invest it first, and then rather spend the rest on setting a specific allocation. Now, obviously it differs from person to person and what your monthly expenditures are, but give yourself a percentage and say, this is my reward percentage that I can now go and enjoy myself with. But there is a certain percentage that I'm not allowed to tap into, and that needs to go straight into my investments. I must make as if I didn't even got that money. So that is what my advice would be on a bonus and a party. And same goes for a tax refund. you guys will find when you go into the corporate environment and you are a commission earner, for instance, you can actually, deduct some of your expenses for tax purposes, and SARS can end up at the end of the year giving you a tax refund. Now, a lot of people use that tax refund and they just blow that money on expensive cars or, on nice luxury items. There's nothing wrong with doing that necessarily if you can afford it. But it's always good to have that specific percentage rule. Have a 1/3 and say, whatever I got back from my refund, put that away and the rest I can then spend. But be prepared. Make that percentage allocation before you receive your bonus or before you receive your refund, so that you know and is not tempted to throw a bigger party than what you're supposed to be doing. Okay, and that was the next question. I think this is also a very important one, is how do I plan to pay off my student loan at NSFAS? What could happen if I delay? Very important to know that, like investments, compounding interest grows on your debt as well. And that's something people don't always take into consideration. Is yes, I can borrow money to study, or I can borrow money for shorter term purposes. But at the end of the day, you need to repay that money that you've borrowed. And the interest rates on borrowing is way, way higher than the interest rates you receive on the growth of your money. So you can find, for instance, if you take out a short-term loan with a bank, they might charge you 24% interest on that loan in the next year. If you don't pay back that interest, your debt grows. So just as your investment can grow, your debt can grow. So you will end up financing debt for the rest of your life because you're not paying enough back onto your debt. And that's why it's important to work out a repayment structure with a financial institution, with a bank, and we'll sit with your financial planner and say, I've got this student loan, how are we going to pay it off? And the first thing I always tell my clients is go to that financial institution. Remember that you can negotiate with banks. You don't always have to accept an interest rate. You can go to the bank and say, I want to refinance. I want a better interest rate. I can afford to put in an extra 10,000 into my study loan, refinance me, get me into a lower interest rate bracket. Make sure that you can negotiate with a bank, because that's why there are more than one bank. You can negotiate that and you can take your financing options to other banks as well. So very important, negotiate your debt, but have a plan, because if you don't have a plan and you end up delaying your repayments on your loans, it can grow, and it can grow very big. And at the end of the day, it will consume your extra disposable income that you could have saved in a tax-free savings and got tax-free growth on that you can retire with if you only paid off your debt in a timely fashion. But you need to be prepared. You need to sit with a planner, determine how much money to put into your debt, and then also renegotiate the terms with the banks. You are allowed to do that. Don't be scared of the bank. You can go to the bank and renegotiate. Okay, and I think this is going to be the last question that I have on the list. I love online shopping, but I feel like I overdo it sometimes. How do I buy the things I love without breaking the bank? Okay, so this one is quite interesting. But it is a very short answer for this. Don't buy with money that you don't have. Now, I know people sometimes think if I borrow money, I have it. It's not money that you have. Money that you have is extra disposable money after you've paid everything that you need to pay and you've saved that you need to save. So don't go and buy and splurge with money that you don't have. Set specific savings goals. So if you do online shopping, make sure that you try and not open those links if you don't have money in your account. That's the most important one. And companies actually catches you. They send you push notifications, and you've got this nice one day only apps and take a lot apps, and they're constantly in your face. put off those notifications if you don't have money. Make sure that you only open those applications when you know that you have reached some savings goal and that you have allocated money, and go and search for specific things. Don't go on the daily deals. It will hurt your budget. And make sure that you only go into these websites when you want to reward yourself, and reward means you've saved up and you have money available to spend on these apps. It can be very devastating. I've seen so many of my clients end up in huge amounts of debt because they can't resist the temptation of buying. And the risk of temptation, it's going to be difficult if you have all these apps installed and it's in your face every day. It's not easy to control the urges if it's there. So get rid of it if you can, and only access these apps whenever you have the money available to buy. Guys, I think that is the most of the questions that I could go through today. I am going to leave my details. Alice and Aka, they do have it. They'll distribute it between you guys. I can do a one-on-one presentation and go through our different funds and the risk profiles of the funds. We can even look at opening up investment accounts for you guys. I mean, like I said, I've got clients that have 100 Rand investments. You can do a 50 Rand a month, whatever you have available, we can plan with that. And then when you start your employment journey, even if you are perhaps employed already, we can look at how your existing company gives you benefits like a pension fund or medical aid. Can give advice on that. If they don't do that and you need medical aid, you can speak to us. I've got an excellent medical consultant that can help you and guide you and make sure we ask the right questions. And then I've also got tax practitioners that help me to help you submit your tax returns and not unnecessarily pay SARS too much money. So we've got a full team of experts that can help you with financial planning. I would really advise, making contact and interacting. The sooner you guys start and the sooner you build up your knowledge, the better it's going to be in the long run. And our monthly correspondence to our clients is not only just your investment portfolio. It's also a breakdown of what's happening in the economy, what's affecting markets, how it's affecting your money and your portfolios. So there's much more detail that we put into our monthly reporting system. We have analysts that we employ on our funds. They give us quantitative data, and we put everything in the monthly one-page spreadsheet to our clients if you become a client of ours to learn. We also have social media pages that you guys are more than welcome to follow. APS is the name of the company. You can look it up on Facebook. I do regular posts there on what is a share, how does a share react, what news articles is there that's appropriate to the financial industry, medical aids, what effects they have, the increases on that. So anything financially related, you can pick up there. You're more than welcome to like and follow our pages there. We've got one on LinkedIn. We've got one on Facebook. And you guys, you're more than welcome to pop me an email as well if you have questions that we didn't cover in today's presentation. But thank you guys for the opportunity. I really appreciate it. And I hope you guys found it informative and that I could answer some of your questions.
Thank you so much, Kelvin, for giving us so much clarity, so many of the things that I didn't know, and some things I didn't think were relevant because most of us are still currently students. But as you said, it's important to start early and get this information early. So thank you so much. And thank you to all the ladies who are attending. As Kevin said, we will send through his details. And once the recording has been uploaded on YouTube, we'll also send through the link for future references if there's something you may have missed or may want to relook, and so you can all be able to do that on the YouTube video. So it's almost 11:30, so I think we can end it here. Thank you so much, everyone, for attending. See you in our next event. Bye.